Welcome to Lender's Digest. I'm Alex Cooper. Today we're diving into the world of mortgage lending and how interest rates have evolved over the past 5 decades. It's a journey that's shaped the American dream of homeownership and had profound effects on our economy. Let's start in the 1970s. It was a time of economic turbulence, with inflation running rampant. By the end of the decade, mortgage rates were climbing into double digits. Can you imagine paying 11% or 12% on your home loan? That was the reality for many Americans. But the 1970s were just a prelude to what came next. The early 1980s saw interest rates soar to unprecedented heights. In 1981, the average 30-year fixed mortgage rate hit an all-time high of 18.63%. It's a number that seems almost unbelievable today. These sky-high rates were a result of the Federal Reserve's aggressive policy to combat inflation under Chairman Paul Volcker. While it eventually succeeded in taming inflation, it came at a significant cost to homebuyers and the housing market. Now let's fast forward to the 1990s. We saw a gradual decline in rates as the economy stabilized. By the end of the decade, rates had fallen to around 7%. This decline made homeownership more accessible to a broader range of Americans and fueled a housing boom. The 2000s brought even lower rates, hovering around 6% for much of the decade. This era also saw the rise of subprime lending and exotic mortgage products. These practices, while making homeownership seem more attainable in the short term, ultimately contributed to the 2008 financial crisis. In the aftermath of the crisis, we entered uncharted territory. The Federal Reserve slashed interest rates to near zero in an effort to stimulate the economy. Mortgage rates followed suit, dropping to historic lows. By 2012, the average 30-year fixed rate had fallen below 4% for the first time in recorded history. This trend of ultra-low rates continued for nearly a decade, reaching an all-time low of 65% in January 2021. It's a stark contrast to the double-digit rates of the 1980s, isn't it? But what do these changes mean for lenders and borrowers? Lower rates have generally meant increased affordability and higher home prices. A $200,000 loan at 18% in 1981 would have a monthly payment of about $3,000. That same loan at 3% in 2021, just $840 per month. However, it's not all upside. Lower rates have compressed profit margins for lenders, forcing many to adapt their business models. They've also contributed to rapidly rising home prices, potentially offsetting the affordability gains from lower rates. We're now seeing rates climb again, with the 30-year fixed rate crossing 6% in 2022 for the first time in over a decade. This shift is causing ripples throughout the lending industry and housing market. So, what can we learn from this 5-decade journey? First, the mortgage market is cyclical. While the specifics may differ, we see patterns of expansion and contraction, boom and bust. Second, interest rates are a powerful tool, capable of making homeownership either accessible or unattainable for millions. They're influenced by a complex interplay of economic factors, from inflation to unemployment to global financial conditions. Third, innovation in lending practices is a double-edged sword. While it can expand access to credit, it can also introduce new risks to the financial system. As we look to the future, what challenges and opportunities lie ahead for the lending industry? How will factors like climate change, demographic shifts, and technological advancements shape the mortgage landscape? These are questions that everyone in the finance industry should be considering. The answers will shape not just our businesses, but the very nature of homeownership in America. For Lender's Digest, I'm Alex Cooper. Thank you for joining us on this journey through the history of mortgage lending and interest rates. Until next time, keep lending, keep learning, and keep pushing the boundaries of what's possible in finance.